Welcome to Going Long with FCLT Global, the podcast that dives into the world of long-term investing and strategic decision-making, hosted by Sarah Williamson. Going Long features thought-provoking conversations with some of the brightest minds in finance, economics, and business today. Each episode will bring you exclusive interviews with renowned executives, investors, and experts who are driving change in the world of finance, getting their unique perspectives and uncovering strategies that have shaped their success. Whether you're an investor, a business leader, or simply curious about the forces shaping our global economy, join us as we explore the power of long-term thinking. This is Going Long with FCLT Global.
Thank you for joining us for Going Long. Today, I'm joined by Jon Gray, the President and Chief Operating Officer of Blackstone. He's a member of the board of directors. After joining the firm in 1992, Jon served as global head of real estate, which he helped build into the largest commercial real estate platform in the world. Jon currently serves as chairman of the board of directors of Hilton Worldwide and on the board of CareBridge Financial and Harlem Village Academies. Thank you, Jon, for joining me today.
Sarah, it's great to be here.
Great. So to kick off, let's talk about something that's just going on in the world with all investors, those who focus on the short term and the long term alike, which is the current economic condition. So obviously there's a lot of uncertainty out there. We've had inflation for the first time in many investors' careers, perhaps not yours or mine, but in many. And how do you think about where we're going, where are the rates going? How are we navigating this kind of environment?
Well, I'm an optimistic person, so I'm going to start with the positive side. And I think the good news is first that economic growth has been faster than I think most people would have expected, given how tight central bank policy has been. Unemployment has remained remarkably low. Growth has been pretty good. And it's not just in the United States, it's been around the world. So that's clearly a positive. The other positive is inflation is coming down. Obviously, headline inflation got as high in the U.S. as 9%. Today, it's in the threes. That's progress. It's not at the Fed's target of 2%. But when we look across our portfolio, what we see is shipping costs coming back to pre-COVID levels. Input costs are now running less than 2%. Wages have gone from, call it 7+% to high fours, heading in the right direction. And rents, the government data is still showing shelter costs up high 7%. In reality, it's probably around 2% or lower. And so I think we'll continue to see pretty good numbers on inflation. And as investors, that was the biggest risk, because when you get a very high inflationary environment, it hurts consumers, businesses. It obviously means multiples come down for companies, cap rates go up for real estate assets. So that's really a positive. What's the negative? The negative is the Fed was late, unfortunately, on identifying inflation on the way in. And as a result, I think they want to be really vigilant here as inflation's coming down. They also, to their credit, look back to the 1970s when the central bank lowered rates too quickly and inflation sort of kept going higher and higher in different waves. And so I think we're going to have tighter monetary policy longer than most people have expected. And when you keep the cost of capital elevated and capital availability goes down, part of that's the banking system, which is under pressure here in the United States. It's like taking oxygen out of the room. And as a result, I think that will lead to a deceleration in economic activity. We've begun to see that in hiring in the U.S. Certainly Europe has slowed more. I think that will continue. It's just very hard to make the numbers work when borrowing costs are this high. So putting perspective around it, we've lived through an inflation surge. We've lived through an interest rate surge. And now we have to endure a bit of an economic slowdown. You know, is it a recession or not? I don't know, but I think we'll feel growth slow. We'll see unemployment go higher. I don't think this is like 08, 09 when we had those very significant imbalances and we saw a very sharp downturn. But I think we'll see a slower period of time, rates more elevated than people would like. But ultimately, we'll get to the other side of this as well. And as a long-term investor, we've got to keep that perspective in mind.
Yeah, that's very helpful. And as we look through this sort of short-term period, one of the concerns some people have is that as money isn't free anymore, that we may scale back on innovation and some of the more innovative things that create value over the long run. Are you seeing that happening? Do you think people are being more cautious about R&D and innovation and taking chances given the higher cost of funds, or do you think that those ideas are going to keep flowing through?
I think it's a little bit of both. I mean, clearly, if you're a company and your financing costs have gone up materially, you don't have as much free cash flow to invest. If you're a growth equity firm or private equity firm and your customers are allocating less to you as a manager, then you don't have as much capital to invest in innovation. So those are headwinds. On the opposite side, the government stimulus, particularly around green energy and the IRA, has led to a surge of economic activity there and investment. And so I think that will lead to more. And then AI, which I'm sure we'll talk about, is leading to a ton of investment because there's a lot of excitement about what this new technology can do, which fundamentally allows machines to not just understand numbers, but now be able to process images and text and what that means for all sorts of businesses. So I think innovation goes on. I mean, if you went back to the dot-com bubble, you look back, there was tons of enthusiasm about the internet. It got a little crazy, pets.com and so forth. But ultimately, that all came to pass, right? If you look at the way our lives have migrated online, I think that's no different. I think innovation continues. Valuations have come down. Capital availability has pulled back. But I think innovation in a lot of ways is accelerating. And if you look at the big companies, where all the growth in the S&P 500 has been, it's around big technology-oriented companies. So I think we'll continue to see capital flow in those areas, maybe not as abundantly as we did in 2000 or 2021, but that's probably a healthy thing.
So let's go to the AI discussion since you mentioned it. There's clearly in the last year or less has been a huge amount of recognition of this and perhaps hype. But if we take a slightly longer, if we could pretend we come back and have this conversation in 5 years, what do you think is going to be? Where do you think the biggest changes are going to be? Because I think as we look at AI, it's being compared to the invention of the steam engine, which of course changed lives in so many ways beyond just the obvious. So is that what you're saying?
I think it's a incredibly powerful set of tools. And I think it will enhance productivity in an enormous way. And there are obviously businesses that can be directly impacted. And of course, we're spending a lot of time thinking about the winners and losers to protect our existing portfolio companies and then deploy capital in the areas that should win from this. But ultimately, it's going to make things very efficient. So if you're in a call center business today, one would think that these machines will be able to do a lot of that automatically. Industries that have a lot of transaction processing, financial services, healthcare, you've got to believe that these repetitive tasks, the machines will be able to process the questions and the transactions, and that will take a lot of cost out of that and provide a lot of efficiency. I think creative industries will be impacted in a really profound way. It could be making music, movies, software. I still think there'll be a human element of this, but you'll be able to think up a scene or something and the machine can create it, or have an idea for software and work with the machine to create it. So I think almost every business is going to be impacted in some way. And as a firm, we've been spending a lot of time. We started back really in 2015, building out our data science team, thinking about how we could help our companies process data to make better decisions, how to price better, how to staff better based on the historical numbers. And we now have data scientists on our deal teams on the equity side when we do transactions, and then we embed them in some of the larger companies as well to add value. I think now there's going to be a new set of tools for these data scientists to use with these companies. And this is a work in progress for us, like it is for everybody else. But I'm in the camp that the changes will be very significant. Some businesses, it'll just enhance cost productivity. Others, it'll fundamentally change what they do. And I don't think you want to be left on the sidelines, sort of hoping nothing's going to change, because I think things will change. And as investors, you want to try to be on the front end of the curve. And some of the early areas that are being impacted, the hard part is to pick which companies are going to get the technology right and so forth. We've often had success in the picks and shovels, right? You don't know who's going to find the gold, but you sell them jeans, you sell them the shovels. For us, data centers have been a great area. We bought a company called QTS for $10 billion a couple of years ago. And all this AI and compute power goes through data centers. And we've seen a massive step function in demand. We provided a bunch of capital to a company called CoreWeave, which assembles these GPUs, the brains of these data centers and AI effectively. And they're on the right end of where things are heading today as well. And so we're looking at ways to support what's going to happen and get favorable returns for our investors. You pointed out there's often a lot of hype, and sometimes things can go too far, too fast. And so you still want to show caution and discipline, but there are ways to play this in companies who are directly in the main business and then derivatively off of it. And I would say definitely spend some time thinking about it and investing behind some of these themes.
And as you put your real estate hat on, how do you think about this? Obviously, the real estate business has been through a few shocks between COVID, rates, nobody wanting to go back to the office, et cetera. Is this another one, or does it, how does your perspective on, because you're obviously a large investor in real estate as well?
Yes. It's interesting. We often like to think about real estate through the lens of these big mega trends. We talk about investing in good neighborhoods. What are the big things that are changing the way people live and work? And how do we express that in private equity or growth or infrastructure, credit, real estate? And we've been fortunate in that we've identified a few of these big trends. In the context of AI, we've been buying data centers in our real estate and infrastructure area. That has turned out really well. I'd say the biggest tech trend that's impacted our real estate business is the movement of goods from physical retail online to e-commerce. And we have today we own about $200 billion on behalf of our investors of logistics assets around the world. And we've seen unbelievable growth in demand, very low vacancy, strong rental growth pretty much around the world. Very different than when we talk about commercial office buildings that have those significant COVID headwinds. They have some obsolescence challenges as well. And so 40% of our global portfolio is in logistics assets. And as investors sort of identifying these big themes and then leaning into them, we found that to be the most important thing, more important than do I pay 100 or 98, which is what you tend to focus on when you're bidding on an individual asset. And so getting those right neighborhoods matter. That's clearly one that's been driven by technology. Also in real estate, housing has been a strong area, really since the financial crisis. Rental housing has been the other very large theme for us globally. And there it's been based on the premise that since the financial crisis, in most developed markets, we've been building at about half the rate that we did as a percent of population than we did prior to the financial crisis. And that creates a structural shortage. And so, again, we express that in multiple ways. Regular multifamily apartments, it could be in single family for rent, student housing, manufactured housing, and all over the world where there's rental housing, Japan, UK, certainly the United States, Canada. So we're constantly looking for these big thematic areas where there are good tailwinds. In commercial real estate, the office buildings face big headwinds. Retail has had a very tough run. Today, the grocery anchored shopping centers, more convenience, are doing much better than the big malls are or the big power centers. But that's a sector that's had a big shakeout given what's happened. And I like this idea of thinking through these trends. Hotels would be another area. We've been a big investor in resorts because we said people are going to still consume, these good experiences. COVID has given a boost because many people take 3-day weekends. I know they're working from home with their families at a resort. And so trying to see these big trends and investing for the long term and expressing it Real estate's no exception. There are obviously some near-term challenges as cost of capital's gone up, but there are clearly sectors in real estate that are winning and others facing some real headwinds.
And would you put decarbonization or sustainability in that long-term trend category? Because obviously some of these you've talked about, logistics, there's some interesting plays there. Real estate is an important part of that. And when you're going to make an investment in some of these areas, how do you think about sort of the future trends around decarbonization and how you bake that into a decision today?
I would definitely put decarbonization, this energy transition, as a mega trend that we're still in the early stages of. The estimate something like 4 or 5 trillion a year for as far as the eye can see. We are still a hydrocarbon dominated global economy, and that will continue for a long time. But we think you'll see sustainable, renewable sources taking greater share over time. And there's going to be a transition that happens over time. I think as investors, one thing that's worth noting is we are fiduciaries first. So if we're investing in this, it has to be because we're generating favorable returns for our customers. So we're very focused on that. But the good news is there's such a massive transition underway that there's a ton of opportunity. And we look at this and say, wow, there's lots to do. In terms of what we find most interesting, we're less focused on some of the early stage sort of VC technology, where I'm sure some people will do really well. But there's, a hit miss element to that that may not necessarily align perfectly with what we want to do. And then we're also at the other end of the spectrum, less interested in fully leased out long-term, let's say solar farms or wind farms that are more like bond-like assets. We would say we want to be firmly in the middle. We want to build new projects where we're getting in at cost. And then when we do that, create value and we get to sell that goodwill on to somebody else. We have a huge investment in a company called Invenergy, which is the largest independent builder of wind and solar projects in the country. So we love that kind of investing. And then back to my picks and shovels, there are software businesses, consulting businesses, grid hardening businesses. There are all sorts of things that are going to happen as electric vehicles take hold, as we have more sustainable sources. You want to try to find different ways to capture that. We've been doing some very interesting things. We invest in a business called ESDEC, which manufactures the necessity, sort of the machines that put the solar on your roof effectively. And a business like that, as you can imagine, has enormous demand today, given consumers' desire and the tax incentives that exist in the US and Europe to put solar on a home rooftop. So we're looking at this in a lot of different directions, lending to people who are doing this. We see it as an enormous megatrend, lots and lots of time and money's going to go into this. But again, through the lens of a fiduciary. And I think these two things line up very nicely. And I would just add one other thing. On our non-energy businesses, we think there's an opportunity. So we own plenty of traditional companies or infrastructure or real estate that consume a lot of energy. But again, through the lens of a fiduciary where you do, better windows, better building management systems, where you get the energy, rooftop solar, all of that, drive down costs, drive returns. So we think in both our energy world, our non-energy world, there's a way to have a very big impact.
Yeah, I think that through this focus on this, there are a lot of these win-win opportunities that you're after. One of the other big trends is, for better or worse, is this sort of global fragmentation and some of the challenges that are happening between the United States and China, or in other parts of the world, or China plus one strategy, as a lot of people are calling. How does that affect your business in a large way, and how are you reacting to kind of the shifting geopolitics? And in particular, one of the things that I see long-term investors and companies struggling with is if they're going to make a decision that's, they can't reverse tomorrow. It's a 5-year decision, a 10-year decision, a 20-year decision. How cautious should they be? How do you bake that into your thinking?
Well, I think this, if you went back in time, it started with the tariffs. Obviously, COVID created a lot of issues what happened with supply chains, shipping costs going up very dramatically post-COVID, geopolitical tensions, the invasion of Ukraine. I think what it's led companies to logically conclude is we can't have all our production in one place. Even if historically that's been the lowest cost place, the most efficient, the best infrastructure to manufacture products, we've got to look at other choices. And so the knock on effect to us is, well, where are things going to go? Where are some of the good neighborhoods that will benefit from companies looking at diversifying their supply chains and their manufacturing hubs? It certainly is beneficial to a place like Vietnam, which is seeing a big surge, particularly in the green energy area. Mexico, low cost, also proximate to the US, trucking, rail. India, certainly a big winner at its scale. We have been, interestingly, after the UK, India has been the biggest repository of our capital on the equity side at Blackstone. We've been at it for a long time. Our focus has historically been on IT services, which has been a very strong area in India, and the rise of the middle class there. I think both of those areas still have very good tailwinds. And we express that by buying IT companies and buying IT business parks, buying shopping centers and real estate, but then buying all sorts of consumer-facing businesses in our private equity area. I think India is going to get a boost from investors and companies who are looking to diversify. So I think the impact of this is production will move around the world. China will continue to be a major economy, but there are some other geographies that are going to see more inward investment, more FDI, and the consumers and businesses around that will benefit. And as a global investor, we obviously have to be aware of that trend and try to see where we can capture it.
Makes sense. One of the things that is, from the outside looking at Blackstone, you have enormous scale. You're such a large alternative asset manager. As you mentioned, you're in these various areas like real estate, infrastructure, private equity, et cetera. Do you think of these, is scale a burden? I mean, in the investment world, sometimes, people get too big and they can't perform as well. Or how do you use that scale to benefit the companies or to benefit your investors?
Well, we definitely have scale.
Yeah.
Today, we have over $1 trillion of assets we manage. When I joined the firm in 1992, as you referenced, we had less than $1 billion. So sometimes it's a little amazing to see what's been done here. And incredible credit to Steve Schwarzman, what he's built. The firm has grown a lot. I would say scale is our number one competitive advantage. I often get that question about, isn't it a negative? And I said, in fact, it's the exact opposite. And it's so for a number of reasons. First off, in public markets, scale makes it harder to buy something less expensively. If you want to buy $1 million of stock in a company, and I want to buy $500 million of stock, you can buy it without moving the market. It's much harder for me. But if we turn that around and you say somebody needs to borrow money at scale, or there's a privatization at scale, or a major real estate asset, the air begins to thin out as you get bigger in size. So we think that's definitely helped us in buying things on the way in. Other advantages of scale are the organization and the resources we get. So our portfolio ops team, our real estate asset management team, we have 300-400 people whose jobs are nothing but to help companies, help assets, drive return on capital, be more efficient, drive their sales, have teams to help on branding, on technology, on purchasing, and use all that scale for the advantage of our portfolio companies. I'd say the biggest thing, though, is the advantage of information. If you really think about investing as pattern recognition, you see a bunch of dots and you connect them and you see them before other people and invest against that. That's how you generate outsized returns. If you're sitting at Blackstone, you're sitting in my seat, you get to see more dots than anybody else. And so if you can connect those dots, it can help you. So, we were seeing signs of inflation at the end of 2020, I think well before other people, given the size of our real estate portfolio, what we have in our credit portfolio, our ports, our operating businesses. We're saying, wow, this is a real problem. In a similar way, as we talked about, we've been seeing these signs of inflation coming down. So it can influence how you think about macro, what's going to happen with rates, what's going to happen with inflation. And then the other thing you could see are these incredible patterns and these mega trends we go back to, which is, wow, we see this incredible demand for data centers in the United States. Maybe we should do it in other places. Or 15 years ago, we're seeing this demand for logistics assets because of e-commerce. Maybe we should go after that as a neighborhood. What's the next trend that we see? Are pushing to India early. This ability to see more of the world, which is the benefit of scale, is super helpful. And we get to see it through all these different verticals. So one of the great things about my job is sitting on a Monday or Tuesday through a bunch of investment committees and see all these different data points of things that are happening. And then you could say to yourself, wow, there's what's happening in the defense industry today may be very interesting because of what's happening in the geopolitical world. And so there's an opportunity. Or, we're seeing a hardening property casualty market because cost of capital has gone up a bunch. And we're seeing in our real estate properties how much more they're having to pay for their property insurance. Doesn't that create an opportunity for our tactical opportunities area, which does sort of creative investing and structured investing? And so for us, operating at scale, big advantage. Counterparties generally are excited to do business with us because they know we have resources. Our customers like the scale because as long as we continue to do a really good job, which by the way, I haven't talked about, the essence of the business, we have to deliver for the customers, but they'd rather deal with us, across 10 different areas than have to deal with 10 different managers to achieve the same thing. So as long as we never become siloed, bureaucratic, but we use that scale to our advantage, then I think it is the best thing we've got going here at the firm, but we've got to constantly focus and work at it.
Yeah, I think I can see that, and connecting those dots is both fun but challenging, right?
It's very hard. And by the way, just making sure we capture the information off our companies and create the right KPIs and so forth. And obviously, in some cases, there are Chinese walls. You can't share all the information, but there's a lot of data we see. We have to capture it. We have to process it. We have to be able to share it. And we're continuing to refine that because we recognize this informational advantage is the most powerful thing we've got. And we've got to use it for the advantage of our investors and the returns we're trying to generate.
So you've mentioned a couple times this idea of investing in good neighborhoods, whether that's a trend or a literal neighborhood. How do you think about investing to make good neighborhoods? In other words, to add to the community. I know you do a lot in that space. So can you talk a little bit about how you don't just, the neighborhood isn't just what it is, how you change the neighborhood, if you will?
One of the great things about being a large alternatives firm is you don't just touch one business, right? Hundreds of businesses around the globe, 13,000 real estate assets, major infrastructure assets. And so if you can come up with a program and do something, again, aligned with your fiduciary duty, you can have impact at scale. So Steve Schwarzman had this idea, worked with Michelle Obama and Jill Biden way back now, almost a decade, I think, or more, to start hiring veterans, more than 100,000 veterans and their spouses across Blackstone portfolio companies. We just had a summit this week around Career Pathways, which is a program Joe Barata, who runs our private equity business, sponsored, where we said, our companies, there's obviously a difficult environment to find labor. There are communities and groups that are underserved. Shouldn't we find a way to open the aperture, hire more people from different communities, underrepresented groups, provide some training and scaffolding, and help our businesses, our portfolio companies, with access to more talent? And we help the companies. And they love this. And we had a bunch of the CEOs and the heads of human resources in here. And that's the sort of thing we can do at scale. And so we're constantly looking for things across our portfolio where we can help communities. There was the crisis in Maui that recently happened with this horrendous fire. And we own a couple of very large hotels there. And, we put together $1.5 million to support the local community and workers who had lost their homes at some of the properties there. We provided all sorts of food and other things and water and so forth. Because we're on the ground in a lot of places, we can get a bunch of people moving in one direction and make things happen. And so I think, again, we've got to deliver in terms of what we do, but we think these things, being a good member of the community, the physical environment, giving back to communities, creating job opportunities, they're all aligned with what we're seeking to do for investors. These things are not mutually exclusive. And I'm incredibly proud of the firm. We have a charitable foundation at the firm that does a bunch of things. We have our Blackstone Connects program, where something like 90%, I want to say, of our employees last year volunteered around the world for some of the local things we do. Like everybody, we're not perfect, but I would say there is a strong desire to be that force for good.
Yeah, that's very inspirational. And I think that those examples of where you can take assets you have and deploy them quickly and to help is terrific. All right. So if the last question I'll ask you is, take out your crystal ball. And if we were having this conversation again in a few years, or if you're looking at those dots that are just kind of fuzzily coming together, what do you see as the big trends over the next period? We've talked about deglobalization and decarbonization, and obviously the AI trend, and maybe that overwhelms them. But is there anything else that we're missing?
Well, I think we haven't talked about healthcare and life sciences. And, if somebody said, what's the biggest change we'll see over the next several decades? I think the intersection of human genomics and our understanding of that, and this big data and AI will allow us to do unbelievable things around precision medicine. And the idea that, you've got a heart condition or diabetes, and we've got two things off the shelf, and okay, the doctor says this, it's going to be a totally different world. And I think that will lead to very significant strides in longevity, and a very changed world that's out there. Because I think that's where technology is going to prove to be the most powerful, just processing all this information and then translating it into improving human health. And I think we'll hopefully be able to intervene in a bunch of areas. My wife and I spend a bunch of time around the BRCA cancer, the mutation on this gene that's actually designed to heal DNA. And when we spend time on it, the folks who have this mutation, unfortunately, have a very high likelihood of developing cancers, particularly breast and ovarian cancer for women. But you see the strides over the last 10 plus years. And we talk about some of the things now that are possible in terms of interception and early detection. It's amazing. And so when I look forward 10 or 20 years, I think that's the area that we will look back and say there have been the biggest changes in sort of my investing lifetime as I look forward.
That's great. That's great. Well, thank you for your insights today. Thank you for your support of FCLT Global, and thank you for focusing capital on the long term, because that's very clearly the way that you and your colleagues think about deploying that capital. So thanks for your time.
Thank you, Sarah. This has been great.
That concludes another episode of Going Long with FCLT Global. We hope you enjoyed our conversation today and encourage you to continue exploring our resources and research at www.fcltglobal.org. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share with others who may find value in Going Long with FCLT Global.